All right, investors, welcome back. I'm your host, Dave, and today we're tackling a stock that's been riding the digital entertainment tide, but also facing some choppy waters. We're talking about none other than Netflix, NFLX, a name everyone knows, but do we really understand where it's headed next? We've done a deep dive, cracked the code, and I'm about to reveal if the bottom is truly in for this streaming giant. So, what's the buzz on the street for Netflix right now? Well, it's a bit of a mixed bag, a nuanced sentiment as we like to call it. On one hand, management came out swinging with their Q2 2025 earnings call, giving us some pretty optimistic full-year revenue guidance. They're talking about favorable currency tailwinds, healthy member growth, and accelerating ad sales, all pointing to lifting those operating margins. Sounds good, right? But then there's this whisper, a market narrative floating around, about a potential Q3 earnings miss. And why? A specific regional risk, a Brazil tax dispute. In fact, if you've been following the news, you might have seen some headlines like the one from a news.tv suggesting Netflix missed Q3 earnings amidst this very dispute. This tells us there's a real concern, a localized but impactful headwind everyone's watching. For those who might be new to the show or just need a refresher, Netflix, Inc. isn't just a household name, it's a global entertainment powerhouse. They're providing TV series, documentaries, feature films, and even mobile games across practically every genre and language you can imagine. We're talking about approximately 222 million paid members in 190 countries, streaming content on everything from your smart TV to your phone. Incorporated back in 1997 and headquartered in Los Gatos, California, Netflix basically invented the modern streaming game. And, as I mentioned, their latest guidance is projecting full-year revenue between $44.8 billion and $45.2 billion, targeting a 30% operating margin, showing confidence in their path forward despite the external noise. Now, let's get into the meat and potatoes, how we break down all this information. We took that optimistic guidance from Netflix and squarely faced it against the market's worries about this Brazil tax dispute. The company says things are looking up with growth and ad sales, but the market's got its eye on a specific regional problem. So, how do we reconcile that? We build scenarios. First, let's talk about our base case, which we're giving a 50% probability. This scenario essentially aligns with Netflix management's positive full-year revenue guidance of about $45 billion, driven by those favorable FX moves, solid member growth, and booming ad sales, which they expect to double year over year. Operating expenses are expected to hold steady, pushing that operating margin target to 30%. We're assuming the content expense ramp-up later in the year is baked into their overall numbers. The Brazil tax dispute, we're seeing it as a localized, manageable issue that causes some minor short-term pressure but doesn't completely derail the positive trend. Technically, the stock's been in what we call a bearish consolidation, but it's been hanging around the upper bound of that range, near $1,256. This tells us there's caution but also potential for a modest move up if it can hold its ground, which supports our 50% probability. To value this, we start with the current EPS of $23.47, project a 25.84% growth for the next 5 years, giving us a projected EPS of $29.53 for the next 12 months. Then, applying a forward PE multiple of 55x, reflecting continued market leadership and growth, while factoring in increased content spend and competition, we arrive at a fair value of $1,624.15 per share. Next, our bull case, which we assign a 20% probability. This is where Netflix really shines, exceeding management's expectations. Think stronger than anticipated member growth, a massive acceleration in ad tier adoption, and a content slate in the second half that absolutely crushes it, leading to a subscriber explosion and almost no churn. The Brazil tax dispute? Resolved favorably, or it just turns out to be a total non-event, minimizing any negative impact. Operationally, they find even more efficiencies, expanding margins beyond what they guided. Technically, this scenario would be confirmed by a decisive breakout and maintain above 1,260, signaling a clear resumption of the uptrend from the current consolidation pattern. The low probability reflects the need for multiple factors to align perfectly for this to happen. For the valuation, we start with that $23.47 EPS, but assume growth accelerates to 30% due to all these positive catalysts, bringing our projected EPS to $30.51. Then, applying a higher forward PE multiple of 60x, reflecting that superior growth and market positioning, we get a fair value of $1,830.60 per share. Finally, the bear case with a 30% probability. This is the more pessimistic view. We're talking about a significant slowdown in global member growth, thanks to intensified competitive pressures and potential market saturation. That Brazil tax dispute we've been talking about? It escalates, leading to substantial fines or operational restrictions in the crucial Latin America region, directly impacting revenue. Ad-tier adoption rates completely miss their aggressive targets, and that ramp up in content expenses in the second half weighs much more heavily on margins than anticipated, maybe even missing that 30% full-year target. Technically, this scenario sees the stock break down from its bearish consolidation below 1160, with those support levels at 1080 and 1030 failing to hold, confirm a downtrend. We're giving this a higher probability than the bull case because the bearish consolidation pattern itself inherently points to a risk of such a breakdown if negative catalysts emerge, and that Brazil news is definitely a potential catalyst. For the valuation, starting again with $23.47 EPS, we assume growth slows significantly to just 15% due to all these headwinds, leading to a projected EPS of $27.09. Then applying a lower forward PE multiple of 40x, reflecting reduced growth prospects and increased risks, we calculate a fair value of $1,083.60 per share. All right, let's pull up the chart. Here's what I'm seeing based on our technical analysis. NFX has been in a pretty tight bearish consolidation range, essentially bouncing between 1160 and 1256 for several weeks now. If we want to see this stock resume an uptrend, it absolutely has to break out and maintain above 1260. That's our key level for confirmation of positive momentum. However, if it breaks down from this consolidation, meaning it drops below 1160, then the next supports we'd be looking at are 1080, and if that doesn't hold, then 1030. So, is Netflix a buy? After weighing all these factors, the optimistic guidance, the Brazil dispute, and those technical levels, my verdict is that NFX is currently in a state of cautious optimism with a lean towards moderate upside. While there's definite risk from that Brazil issue and the overall bearish consolidation, the company's underlying growth drivers and management's confidence give us more reason to believe in the upside than a complete collapse. The bottom isn't definitively in, but we're seeing more signals for stabilization and potential growth than a sustained plummet. The most probable outcome, our base case, points to significant upside from current levels. Based on our scenario analysis, our base case fair value is $1,624.15, and our bull case fair value is $1,830.60. While we also have a bear case at $1,083.60, given the higher probability for the base case, I'd be looking for strong entries near the lower end of that current bearish consolidation, around the 1160 mark, or even looking for a confirmed breakout above 1260 if you're a more aggressive buyer playing for the bull case. Those are the levels to watch. All right, my friends, that's our deep dive into Netflix. What do you think? Is the bottom in? Let me know in the comments below. Don't forget to smash that like button, subscribe to the channel if you haven't already, and hit that notification bell so you don't miss our next episode. Thanks for watching, and I'll see you next time. Remember, folks, I'm Dave, and this is the Bottom In, but I am not a financial advisor. This is not financial advice. All information presented here is for educational and entertainment purposes only. Investing in stocks involves risk, and you could lose money. Always do your own thorough research and consult with a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.